financial planning. Today, we're going to dig into the importance of financial planning for families, and we're really hoping that out of this presentation, you're going to be able to have some actionable steps that you're going to be able to put in place so that you can build a strong have a strong financial footing. So I would like to introduce myself. I'm Cecile Hult. I am a partner and private wealth advisor with Origin Bridge Advisors. I'm a CFP, certified financial planner, and certified divorce financial analyst. I know that's a mouthful. And just, basically to make this easy, I'm basically a financial advisor who specializes in helping people going through transitions such as a divorce, pre and post divorce. I really enjoy helping people post divorce and building that new financial footing. And Elina will tell us more about it in a second, but this is basically how the idea of this presentation came about, is that we see so much of the ugly effects that divorce has on families, that we wanted to talk about how can we prevent divorce, can we talk about strengthening marriage. So Elina, do you want to tell us a little bit more about yourself?
Absolutely. So hello, everybody. I'm Elina Cannon. I'm also a private wealth advisor and a divorce financial planner at Origin Bridge. So what that means is I spend half of my time working with individuals and with couples, with families in normal financial planning. And then I spend the other half of my time working with spouses going through divorce, helping them really understand their options in divorce, the tax implications, liquidity implications, really giving them that information that's necessary to make those really good informed decisions so they're good and comfortable walking into their next chapter of their lives. I'm also, I was married, then I was divorced, and now I'm remarried. I have two beautiful sons. Cecile is also a super mama. She has two beautiful children as well. So just building on what Cecile said, we have a lot of expertise and experience working with individuals and with families on both sides. And we have a lot of lessons learned, I think, from working with clients, some from my personal divorce and remarriage too, where we just wanted to share. And because we are so passionate about just doing the right thing, supporting, especially families, supporting both individuals, supporting the children. So that is the whole reason why we put together this presentation today. So with that, I think we have a really exciting agenda for the rest of the presentation. We're going to start by talking about the importance of financial planning for families. We talk about financial goals and priorities, really getting aligned on those, and have a really good understanding of financial resources. Those resources are essentially, that's what drives, that's the starting point that helps really get to those goals, those prioritized goals. And we'll talk about goals-based investing, just giving you some basic understanding, some basic terminology about investments. And then we'll talk about teaching financial literacy to children, because they're our future.
Very important. They're the next generation.
Absolutely. So we're going to start off with, this is a little bit of a harsh statistic, but we'll turn it around. Just bear with us. And this is based off of our experience. Everyone kind of knows the statistic, half of all marriages end in divorce. And of those divorces, more than half, 56% of divorcing couples, they cite financial issues as the deterioration of their marriage, their reason for divorce. And we experience that. We hear it from our divorcing clients all the time, right? We hear, oh, my spouse controlled all the finances, she didn't let me in, kept me on, a tight budget, all these things where it was evident that the two spouses didn't have these financial conversations, didn't act as a team when it came to the finances, the understanding, the decision making, and that led to the deterioration of the marriage. So really getting that base understanding of finances, and you don't really need to know everything about finance. Cecile and I have spent a lot of time both getting educated and working in finance. You don't need to replicate
Right.
Cecile's and I experience and education. You just need to know about your own finances. And you need to have that understanding to have that good conversation with your spouse to really strengthen your marriage and work together to ensure that you're on the same path for your family, for your family's future.
Yeah, great points. Oops, sorry.
So just reinforcing, right? It's important to have those conversations and plan together as a family, because financial planning as a family for the family builds that strong foundation of shared knowledge, trust, collaboration, and this shared sense of responsibility.
Right. And I would even add there that it's okay for one person to be the household CFO. There's nothing wrong with one person being more comfortable with finance in the couple, but it's still good for the other spouse to still know what's going on. As you said, Lena, we see too many people just not being engaged in the finances, and then something goes wrong, and all of a sudden it's just too late to do anything about it. So it's definitely healthy to have everybody being knowledgeable, even if not everybody's like paying the bills or being the household CFO.
Absolutely. And we sometimes see it too with happily married couples, but sometimes if one of the spouses who's the CFO spouse passes away,
Mhm. Or
unfortunately.
becomes disabled. We've
Yeah,
unfortunately have that experience.
yeah. And it's very difficult when the non-CFO spouse, if they haven't been part of those financial conversations, they have a very steep learning curve to
Mhm.
come up to speed and kind of step into that role. So it's not that they need to be necessarily like in the same role all the time, but they need to have like a little bit of understanding and be somewhat prepared when the time comes if they have to like step into more of like that CFO role.
Definitely. So, we're saying a lot of things and probably sounds overwhelming right now. So how do you go about getting a better understanding of your finances? And I think the first thing that we share with people is, first of all, financial planning is a process. It's not something that you do once and then you forget about. So you really need to take the time to sit down and understand what are your goals, what are your priorities, and Elena said it earlier, what are your resources? There's no, sometimes we'll have people say, hey, did you hear what Susie Orman said? Or some of those very famous financial planning people are on TV or on the radio. And I think that their advice is wonderful, but it's not customized, right? Everybody's situation is so different. And we have people who come to us and say, hey, my goal is to retire at 40. I don't want children, and I'm just going to, how do I get there? And the solution will be sorry, my French is kicking in, drastically different from someone who wants, 5 children, and it's like, I'll work as long as I need to provide for my family. These are two completely different situations, and the list goes on. So the very first thing you need to do with your spouse is sit down and get an understanding of, what are we solving for, what is important to us, what are we trying to achieve, and then you start getting an understanding of what are our resources, what do we have to work with to make our plan work. Our uh, Diane, who's a managing partner of Arjun Bridge Advisors, always says, the money only funds your plan. So first you need to understand where you're going, have that roadmap, and then you need to understand the money and the resources. So the very first thing that we have people do when we first meet with them is start building that net worth statement and getting an understanding of, where is your money? And it may sound like a basic concept, but when we ask people like, what is your net worth, or what are your assets, what are your liabilities, more often than not, people don't really know how to answer that question. So again, it may sound simple, but it's not, because most people don't really know where everything is. So When I talk about assets, I talk about everything that's on the plus side of the balance sheet. So it's something like bank account balances, it could be investment accounts, could be retirement, IRAs, 401ks, 403bs. If you're a government employee, it might be your TSP. Everything that you own, even including some valuables. We don't ask people to list everything that's in their house, but if you have expensive jewelry, expensive art, cars can go on that net worth statement. And then of course your home, especially if you're listening from the Northern Virginia area, your home is probably very, very valuable, right?
Mhm.
So don't forget about your home. But there can be other assets like rentals and things like that. So first, start listing everything that you own and start gathering statements for all of these things. The second thing that's important to build a net worth statement is understanding your liability. So that's anything that's on the negative side of the balance sheet. So oftentimes we think of credit card debt. Hopefully, that's pretty minimal, but it's very important to acknowledge, right? Um, and then mortgage is a typical liability that people have. It could be a car loan, it could be a debt to a friend or a family. So anything that's on the minus side of that equation, or student loan, all that belongs in the liability category. And once you understand what's on the plus side and what's on the minus side, then that's how you get to a net worth. So in the example that we have here, um, Jack and Jill basically have $576,000 of non-retirement assets. Then they have 1.1 million in retirement, so their liquid net worth is 1.6 million. Then they have $2 million in real estate between their home and their vacation home. They have $60,000 worth of cars. So their total assets are 3,736,000, but then they also have liabilities. They have 804,000 of liabilities between the mortgage and the credit card balance. So their total net worth is at 3.7 million minus that 804. So we get a total net worth of 2,932,168 for them. So again, not a difficult concept, it just requires spending a little bit of time gathering documentation and putting it on paper. And by the way, we'll talk about this later. If you don't feel like doing this yourself, just gather the documentation and provide it to a professional and they can do that for you.
We can do that for you.
Right, exactly. So we talked about the importance of building that net worth statement. And obviously the bigger your net worth, the easier it will be for you down the road and the more resources you'll be able to depend on. So Elina is going to walk us through how do we build that net worth, and that's all through cash flow, basically.
Absolutely. So here too, I think it's really important for both spouses to have a good understanding of cash flow. What I mean by that is all the income that's coming in and all the expenses, so the cash that's going out. Sometimes people refer to this as like a budgeting exercise.
Mm.
We
We don't like budgets.
I don't love budgets. Um, Instead, I like to think of it more as getting aligned on a healthy lifestyle. So I think a budget's similar to diets. Diets are they're usually very difficult to sustain. Similar budgets are hard to sustain. What we work on more is just like getting aligned on a conscious spending, saving, and investment plan. So starting with the income side, if you'll see on the slide. So it's really important to really understand everything that's coming in. So coming from employment income, and even employment income, the base, the bonus, if there's any type of deferred compensation, everything that's coming in there from employers, as well as any type of business income, rental income, investment income, trust income. And then on the expense side, it's important to have like a really good understanding of all those outflows. So on housing, if you own a house, the expense is more than just the mortgage payment, which usually is principal and interest and maybe tax and insurance. But there's all those other housing costs, the housing carry cost, right? So there's the maintenance, there's the repairs, there's the utilities, there's the yard work. So having a full understanding there is important, and it's usually a big chunk of most people's expenses. If you rent, then there's similar type of like rental expenses. There's the actual rent, and then there may be like a renter's insurance and still utilities and maybe some like other maintenance costs, transportation expenses, kid expenses, personal health and medical expenses. And then so savings. There, I think it's very important to get aligned on, especially thinking about those goals, those priorities. How much do you want to save each month, each year, as a collective, as a family, to meet those goals, meet those like priorities? And taxes. Taxes, they're not fun, but they're important. They're important that they get paid. Otherwise, right, you're subject to penalties and fees. So it's also important just to really have like a good understanding on what those taxes are for the month, for the year.
Mhm. And if I can piggyback on what you said about savings, Elena, I think it's just it's such an important point because we see so much tension sometimes between couples about about cash flow. And there's often a disagreement, or there's often a spouse who thinks, well, I don't spend much, but my spouse spends a lot. And we really see a lot of friction there. So that's why it's good as a family to understand what your savings target is, and if that's reached, then you can have a little bit more of a guilt-free spending and permission between the two of you to spend money. And then truly, if you're not reaching your savings goals, then that's probably where you want to sit down again and look at expenses and think, where can we cut? Or on the other side, look at income and say, hey, could we be earning more? Should I look for a different employment? Would I look for a part-time job, and so on and so forth? So I do think savings is so important, and cash flow drives everything. If you don't have positive cash flow while accumulating, while working, then it's going to make things a lot more difficult down the road.
Yeah, and comparing it back to the parallel to healthy lifestyle, diet, exercise, right? If your goal is to have a healthy lifestyle, then it's important, right, to exercise and eat well the majority of the time. But it's okay, it's stressful and it's not helpful if you fret over every single like little calorie, and if you have like one indulgence like a chocolate chip or a cookie or ice cream bar, that's not going to like throw your life. If you're embracing a healthy lifestyle, that's not going to throw, your healthy lifestyle out the window. As long as like you're staying consistent the
Mm-hmm.
majority of the time, say 80% of the time with like your healthy lifestyle. So I think that's similar with finances, right? So if you have
So
that,
true.
if you have that aligned savings and investment plan, right, then it's okay if there are some like indulgences with spending here and there, right? You upgrade your kitchen, you get the nicer cabinets. That's okay for like a one-off, as long as like for the most part, you're sticking to that savings and investments. And I love this quote from Atomic Habits by James Clear. Your net worth is a lagging measure of your financial habits, just like your weight is a lagging measure of your eating habits, and your knowledge is a lagging measure of your learning habits. You get what you repeat.
Mm-hmm. So true.
Absolutely.
Um, so once you do manage to build that excess cash flow, you understand your cash flow. The question that we often get from people is like, well, where do I start? There's so many competing priorities, right? And there's so many different savings vehicles available out there. If you're employed, you probably are eligible to contribute to a 401k retirement plan. You're also eligible to contribute to an IRA. There's investment accounts, there's college savings accounts. So, but your pie is only so big and you can only cut it so many ways. So where do you start? We love this chart. I mean, it's not, again, your situation is unique, so this may not completely apply to everyone, but I think this is still a very helpful cheat sheet about how to prioritize where to invest the next dollar. So our recommendation always starts with an emergency fund. You I always, if you think of your your fa your finances as a house, your emergency fund is your foundation. You have to have a foundation because this will protect you from, bad luck in the way of losing your job or having an expense that you didn't anticipate, etc. It will keep you away from credit card debt, which, in my opinion, is just the root of all evil. So, start with strong emergency reserves. A rule of thumb is 3 to 6 month worth of your expenses. Again, this is just a rule of thumb. Yours could be different depending on your circumstances. If you're self-employed, you're a small business, you may want to have a little bit more, but if you work for the government and your job is very steady, then you probably can afford to have a little bit less there. So 3 to 6 months of emergency reserves is so important. Then take advantage of the free money that's available to you. So if you're employed and you have access to a 401k that matches, contribute at a minimum what your employer will match. If your employer matches the first 5% that you contribute, then contribute 5% to your 401k. That's free money. Same thing with health savings account. If it's eligible for a match, contribute, get that free money, get that match. Then the thing that always, I mean, I think I've already made it clear, but I really, really don't like credit card. I don't like high interest debt. You're just paying a financial institution um, in lieu of paying yourself. So, again, it's just a rule of thumb there. But typically, anything that's more than 8% interest rate, try to pay down pretty aggressively. Again, if you don't have a choice, then that's okay. But it is good to pay that pretty aggressively. So, I think of credit card there, but sometimes the student loans can be pretty high. Any loan that you have that has that kind of interest rate, try to pay down pretty quickly. Then the next thing that we would recommend is to maximize your contribution and defer income, especially if you're a higher earner. There is a great benefit to deferring your income to a 401k, because then you essentially drop your tax bracket. So it's very tax efficient to contribute to, again, 403b, 401k, TSP, whatever is available to you. And then max your health savings account also. After that, again, I know there's so many competing priorities, but if you have children, it's probably not a bad idea to at least start saving toward college. We like the 529. I'll talk about it a little bit more in a second, but it's always better to start rather than doing nothing. If you wanted to fully fund a 4-year in-state tuition from the date of birth, it'd probably be $500 to $600 a month. So it's not little, and not everybody can do that right away, especially young families when they also are saving for a house, etc. But I think it's better to start and maybe do $100 a month rather than not doing anything at all. After that, we talked about paying down high interest bearing accounts. After that, I would say start paying down those other loans that are maybe not as much as 8%. But I'm thinking of maybe a car loan that's at 5%, or a student loan that is at 5-6%, and so on. So again, there's good debt and bad debt. I'm not necessarily encouraging people to pay down their mortgage if they have a 3% mortgage. And they basically take advantage of the mortgage interest deduction. So again, everything is very unique to everyone's situation. But I think this is kind of a good rule of thumb there. And then of course you can contribute to IRAs. The reason it's not a priority here is that most people make too much money to contribute to a 401k and also have that IRA be deductible. If you can contribute to a Roth, I think a Roth is a wonderful option too. Again, if we had 3 hours on this webinar, I could dig down to everything. But again, this is kind of a good roadmap, but it's not necessarily applicable to everybody. And then finally, if you have excess cash at the end of all this, you can definitely open a taxable account and start doing some investing there too. So a second ago, I promised I would talk a little bit more about 529s just because it's such a popular topic with young families and families in general, even grandparents who want to save for their grandkid college. 529 is essentially a savings vehicle for higher education, although the Secure Act changed some of this and made it a little bit more flexible. So broad brush, it's meant for higher education savings. It is tax advantaged, which is why it's one of our preferred means to save for college. Any growth in that account will be tax free if it's used for higher education. It usually has a good amount of investment options. It's very flexible. You maintain control as the owner. You can usually change beneficiaries as long as they're related. There are some drawbacks if you over contribute or if you don't take the money out for higher education or qualified education. Then there's some penalties, but again, there's just ways of getting money out now. They're more flexible than they used to be. And it's also a wonderful estate planning tool for higher net worth families because the money essentially passes down to the next generation and is excluded from people's estate. So we're not going to dig deep here, but just know that 529s are a great tool to save for college, and we really like them. So we talked about prioritizing savings, and once you understand where to allocate your next dollar, then I think it's so important to get started now because I know it may sound cheesy, but time is truly money. And Elina is going to walk us through this chart because I think this chart is worth a 1,000 words.
Absolutely. So this chart really shows that power of compounding on your investments, right? So saving and investing early and consistently over a long time period is really important to your retirement success. So what this chart does is it compares 4 different retirement outcomes based on various saving and investment behaviors. So if you look at the very top, that blue line, that is a consistent saver and investor that started at age 25, saved $200, invested that $200 every single month. So even though the principal, like what they saved and invested, was $96,000 from age 25 to age 65, it grew to $512,700 because mostly driven by the compounding return on that original investment. And you can see that on the very right at the top. You see like kind of the more patterned part of that circle chart shows 19% of that 512,000 is the savings, whereas the other 81% is the power of compounding. That is the investment return. And then moving further down, the black line and then the black circle on the right, that is our early saver and investor that saved similarly the $200 per month, but only from age 25 to 35. And then they kept their investment earning a return, but didn't add to it. So for that reason, it still grew. It grew to 270,100 by age 65, but it's not as large of a retirement portfolio because they stopped contributing those like savings and investments after age 35. And then the purple line and associated circle, that's the late saver and investor. So they started at age 35. So a little bit of a late start, but that's okay. That is okay.
Better than never.
That's better late than never. Same thing, save 200 invested it in the market, earned that return, compounded the returns. So their savings grew to 242,600 by retirement age. And then last but not least, but kind of least, is the consistent saver, the green line. So they saved $200 a month, same as everyone else, from every month. So from age 25 to 65, but they did not invest in stocks and bonds. They just held their savings in cash. So their return on cash was 2.3%. So cash historically has not produced the same returns as stocks and bonds. So for that reason, their cash, the 2.3%, that compounded, but slower, less than the other portfolios that were earning a return of 7%. And so for that reason, the consistent saver in cash, the green line, by retirement only had 158,300. So smallest retirement portfolio of the four.
Wow. So start early, but also invest early. Saving alone is not enough.
Yeah, it's the
So I
old.
can,
Sorry, it's old saying. It's not timing the market; it's time in the market.
right. No, that's absolutely true. And I can already hear people saying, well, what if there's a correction in the market, and so on. So I think this next slide is interesting too, because we're not saying invest every penny that you're saving. Back to our prioritization and our goal-based investing. So we still recommend that you have an emergency fund, right? So that should sit in cash or money market right now, because money markets are yielding a decent amount, but it should definitely not be invested. So anything that's earmarked for the short term, we do recommend keeping very liquid, very safe, because it is hard to predict what the market is going to do from one year to the next. And it's illustrated on this bottom chart here. Over a 1 year period, the stock market has been down as much as 39%. It didn't happen often, granted, but it's happened before, and it's been up as much as 47%. So the range is huge there over a 1 year period. So that's why, if you tell us you want to buy a car or a house next year, we're certainly not going to tell you to keep that money in the market. We would say, hey, keep it very safe and liquid. So any short-term goal, including emergency reserves, probably ought to go into a cash or cash equivalent savings account or something like this. The more time you have on your side, the more you can afford to be growth oriented. Because as I said, over any 1 year period, it's impossible to know what the stock market might do. But if time is on your side, you can see on the right side here, if you had a 20-year rolling period, the stock market's never been negative on a 20-year rolling period. The worst it's done is 6% per year. The best it's done is 17% per year. So again, the more time you have, the more growth oriented you can be. So for anything that's a long-term goal, and if you're young, you can afford to be very growth oriented because time is on your side, and that's where you'd probably want to have more in stocks than bonds. If anything is more of a medium-term goal, so 5 to 10 years, saving for a kid's college, saving for buying a home 5 years down the road, is where you can be a little bit more balanced. And you'll see there too that you don't necessarily need to be all equity, all stocks to grow. You can grow with a mix of stocks and bonds. But again, to go relatively quickly over this, I would say if you're saving for retirement in an IRA and a 401k, you can probably afford to take more risk and have more in stocks. If you're saving for again, saving for a down payment in 5 years, or a car in 5 years, or maybe a vacation home in 10 years, and this is when you can be a little bit more balanced, have a little bit in the market, but have a little bit in bonds, and anything short term, again, has to be safe. I always call your your cash in your bank account, your insurance policy against a bad market. So we can't control the market, but we can certainly control our allocation and how we invest the money. So no, we're going really quickly over this, but hopefully this concept makes sense. Align your investments with your goals and your time horizon. And you know, if you turn on the TV, you're probably going to hear a lot about the hot stock or what's done well. But Elina, can you walk us through what it means to be diversified and have asset allocation in our portfolio, and why it might be beneficial to take that approach?
Absolutely. And fully recognizing there's a lot going on in this slide, so bear with us for 2 seconds. Related to what Cecile just asked, we oftentimes get the question, how do I start investing? What stocks do I buy? Should I put all my money in Apple?
Nvidia or Meta?
Yeah, Nvidia, Meta, right? Tesla. What are the 5 stocks I should buy? And so what this slide shows is stock selection is difficult and volatile. What is better, what we recommend is a diversified investment approach. And so what this slide shows is all those little color-coded boxes are different types of asset classes. So it's showing, like, even within stocks, there's different categories of stocks. There's what's called like the large capitalization stocks and the mid cap, like just those are like the Apples, the Metas, the Googles. So those household kind of big stock names, and there's mid cap and then there's small cap. And even within bonds, there's different types of bonds too. There's what's called investment grade, and there's high yield, so not investment grade, and municipal bonds. So the thing that you can see here, this shows the return of those different types of asset classes, and there's a lot of different colors. So
Mm-hmm.
shows
But
return.
notice how not one color is consistently at the top.
Absolutely. Yeah. So from 2008 to 2023, which is what this is showing, there's different colors at the top and different colors at the bottom. So different asset classes they're not consistent, right? They're all producing different returns every single year. What is shown by that white box, that is a diversified or invested portfolio. So it's never at the top, it's never at the bottom. It's for the most part in the middle, right? Producing like pretty consistent risk adjusted returns. And this is something that we definitely recommend. You work with a financial expert, you work with like a financial advisor to really come up with that diversified investment approach that makes the best sense for you, given your goals, your priorities, your risk tolerance, and given the current environment, what's going on with the broader economy.
Mm-hmm. Great point. So we talked about investments, and again, investments are very important. They're one building block of a solid financial footing. Another building block is risk management, as well as estate planning. So what we mean by risk management is basically protection. So insurance. It's very, very important to have insurance for a few things, because those costs could be very dramatic and really wipe out a lot of your savings if you don't have that correct insurance in place. So health insurance is a big one. You know, you see it anytime you go to the doctor, or if you've ever been to the hospital and you look at that bill, if you didn't have that insurance, that could be a huge expense that you would need to absorb from the portfolio. So most employers offer insurance. You know, most self-employed people have access to insurance, even if it's expensive. We believe it's worth paying, because the alternative is extremely risky. Property insurance is essentially your insurance on your home, on your car. Again, these two are essential to have, but also another thing that people tend to overlook but is important is liability insurance. So it's, if you got sued for something, sometimes I use the example of if someone walks on your driveway and slips and fall in the winter, they could sue you for not properly taking care of your property and them hurting themselves on your property. Or I was also say Northern Virginia, it's probably not that difficult to find someone making $1 million a year. You rear end them and they can't work for 6 months, and all of a sudden they sue you for all their lost wages. So home, auto, liability are very important to review at least annually. Life insurance is another one. I'm not a big fan of life insurance for the sake of life insurance, but I do think it's worth looking at who are you trying to protect, who is dependent on your earnings and your income, and what would have happened to them if you were not around anymore. So, if you have children, if you have a spouse, how much should you get on yourself so that they would be taken care of if you were not around? So again, life insurance could be a whole seminar on its own, but just a reminder to review that periodically, especially as needs change. If you were single for 20 years and all of a sudden are starting a family, then that's when your life insurance needs change. And in disability insurance, there's short-term and long-term. I definitely recommend that most people get long-term. Short-term can often be covered by an emergency fund just because it tends to be more expensive. But for women who anticipate having children, it's not a bad idea to get short-term disability insurance too, because it could cover some of those pregnancy time off that you might take. So. But disability insurance can be very expensive. It's not part of a group term, so group policy. So, but again, it's just so important, because if you couldn't perform the work that you're performing because of a disability, that is extremely costly. So, coverage worth exploring at a minimum. And then estate planning is very important too. We often think of estate planning as do you have a will and what happens to you if you die, but maybe not more importantly, but equally as important is what would happen to you if you couldn't make your own decisions. Who would make decisions on your behalf if you couldn't take care of yourself, if you had a medical issue? So it's important to have medical directives in place. It's important to have a power of attorney. If again, you couldn't make your own decisions, who do you trust to manage your money? Who do you trust to manage money for your children? So all of this is very, very important to have in place. And again, we could spend an hour on this topic alone, but it's good to meet with an estate attorney. And we're not a big fan of, going online and doing it yourself, because you truly don't know what you don't know. And it doesn't have to be thousands of dollars to do an estate plan, but it's worth having it reviewed by a professional for sure. So I think while parents tend to lead the charge with managing the household's finances, it's definitely never too early to have your children involved. And it can start at any age. Elina, I don't know if you want to talk about this a little bit more, but we're very passionate about educating kids and always talk about how do we involve our own little ones into their day-to-day finances.
I love talking money with little ones. So when your kids are young, they're super little, we recommend introducing the value of money, emphasizing saving, and introduce them to investing. So what I do with my little kiddos, and they're very young, we have a chore chart.
Mm-hmm.
Once they have check marks, once they check off 20 chores, they earn $5 less 10% tax.
Oh, I like that. That's brilliant.
So they understand taxes, they receive the $4 after they check off the 20 boxes, and then we introduce the idea of saving and investing, the idea of delayed gratification. Every week that they hold their cash, their $4, they get another dollar. So if they can hold off for a week, 2 weeks, instead of $4, 2 weeks, they can have $6 so they can understand that delayed gratification earns them that bigger, better toy that they may want.
It's a marshmallow test with money.
Absolutely, absolutely. And then when they're teenagers, we recommend encouraging a summer job. If they have earned income from that summer job, then you could consider investing, putting that money into a Roth IRA. And that's a great opportunity for them because Roth IRA, you put in post-tax earned money. And so their tax rate when they're a teenager is very, very low, near zero.
Yeah.
And they can withdraw later in retirement tax-free. So there's just a really great opportunity for them to set themselves up for retirement success starting as a young teenager. And also at that time, we recommend introducing them to your wealth advisor. So they just like to start having a really good understanding of personal finance. We actually have a wealth advisor at our firm in Arch and Bridge that really focuses on the children of our clients and educating them on what it means really to save, to invest, and to prepare for a sound financial future.
Mm-hmm.
And then when your kids they become young adults quickly, right? In a matter of 2 seconds. Then we recommend helping them set a saving and spending plan and introducing them to responsible credit, maybe helping them open up a credit card, teaching them to
And paying it off every month.
absolutely only put on a credit card what you have the funds to pay off every single month. So you're building that good credit history, you're building up that credit score, but you're not racking up unnecessarily like interest fees.
Mm-hmm.
And then just continuing to offer support, continue to potentially bring them into wealth advisor conversations, maybe set them up with their own advisor. So they're able to manage their money, especially as they start making their own and they start planning for their own retirement and well, even before their own families, little grandbabies and their own eventual retirement as well.
Mm-hmm. No, it's great. A quick thing about the Roth IRA, I love that idea. And I've seen a lot of parents do some matching too. So for instance, if a kid earn 1,000 during a summer, maybe they contribute 500 to a Roth, and then the parents match the other 500, just again to encourage them with saving and rewarding good behavior. You certainly don't have to do that, but I kind of like that idea because it just teaches them to maybe contribute to a 401k early on and taking advantage of that match and encouraging that great behavior of saving early.
I love that.
So we talked about a lot today. And as Elina said, you don't have to become a financial expert. We're just hoping that everything that we covered was helpful and these are steps that you can implement right away. But we fully understand that you probably have a full-time job, you probably have a family to take care of. So feel free to reach out for help. You don't have to do it alone. So we just wanted to share some of the services that we provide. We definitely provide financial planning, that comprehensive financial planning that we talked about. We also provide asset management. We can help with budget review and analysis. We love, love, love financial education. So all of our clients always get a lot of it, as much or as little as they want. We also understand everybody's time is valuable, so we don't try to overshare either if people are not interested with knowing all the nuts and bolts. But we do want to make sure that everyone is educated about broad brush idea of their own financial situation. So we have a lot on here. Insurance and risk planning is very important too. Again, life insurance, disability, long-term care as it may be appropriate. And then hopefully you never reach out to us for this because you're going to implement everything that we talked about and you never need the divorce financial planning, but this is also something that we do offer. And actually, if you're considering getting married anytime soon, we also do prenup kind of consulting and analysis. because sometimes as people, especially as people get married later in life, they often come into the marriage with their own wealth, and they sometimes want to protect that those resources in case of an unfortunate divorce down the road. So definitely a lot that we can help with. And again, we're very passionate about educating people. So we offer 20-minute complimentary consultation call. So feel free to grab some time on our calendar, and we're happy to chat through your situation and answer some of your questions. So we're here as a resource. Reach out to us, and we hope that you enjoyed today's presentation. Thank you for joining us, and thank you, Lena. Love all your point of view about everything.
Thank you, Cecile, and thank you everybody for joining us. Please reach out. We would love to be your resource.
Absolutely.